Hey, what's going on, PFR Nation? This is Kevin Lau, your host of the Planning for Retirement podcast. And today we're going to be talking about using your unrealized losses and turning them into a war chest to create tax-free income in retirement. Yes, I'm describing tax loss harvesting inside of a brokerage account. So if you are investing outside of a 401k plan, let's say you're maxing the 401k, you're maxing the Roth accounts, you're maxing the mega after tax. Okay, you're doing all the things, you're maxing the HSAs, but you still have funds left over to invest. This is a lot of you that are in PFR Nation, all right? Now, you're probably directing those funds directly into a taxable brokerage account, hopefully, and getting those funds invested and tax optimized. Now, that is the key. That's one of the mistakes I see a lot of investors make is they funnel them into a brokerage account and they invest in like a high yield savings account or a CD or a money market account. Yes, these yields are attractive. They might be paying 4 or 5%, but that's 100% going to be taxed as at your marginal rate. It's going to be taxed as ordinary income. So it's the least efficient from a tax perspective vehicle to invest in within a taxable brokerage account. Hopefully you're investing in equities. Maybe it's ETFs, mutual funds, all right? And you have exposure to the stock market so you can actually grow your wealth over time as opposed to just keeping pace with inflation or worse, lagging inflation. So we're going to dive into this in the whiteboard. Again, the title is using losses to your tax advantage. And so let's talk about that. So let's talk about realized losses versus unrealized losses. So if you're investing inside of a brokerage account, and I'm going to just use a real simple example. I'm going to say you have $1 million in VTI. Okay. And let's say and that's also your cost basis. Okay. So that's what you paid for it. But let's say just the timing of it, you got that money in there. Maybe you sold a business and you invested $1 million in VTI. And we just had some volatility. Maybe the election happened, okay? Which is happening next week. Maybe the election causes some short-term volatility. Maybe it's some kind of geopolitical event, all right? So, maybe it's something short-term in nature. It could be even more sustained. 2022, we had significant inflation. We had high interest rates on the rise. We had a rocky year. 2022 was a rocky year for stocks and bonds. But let's say you had some volatility going on, and let's say all of a sudden you check your statement, and now your portfolio, that VTI is only worth $800,000. Well, this is what's called an unrealized. Whoops. Now you have a $200,000 unrealized loss. This does you no good. All right. Now, obviously, you want to stay steady. You don't want to just bail out of your investment strategy just because you're reacting to short-term movements in the portfolio. But for brokerage accounts, this is a great opportunity to essentially turn this unrealized loss into a realized loss. Okay. So how do we do that? We actually have to sell VTI. And if we sell VTI, now we have this $200,000. We turned it into an unrealized loss. Now we turned it into a realized loss, and you can use that $200,000 to your tax advantage. And we're going to show you how in just a second. The first way we can use that $200,000, I'm going to just put that number up here in the corner. We can use that to offset capital gains. So let's say throughout the year, you're also buying and selling other investments within your portfolio. And let's say at the end of the year, you add up, you see your 1099, you add up all of your capital gains throughout the year. And let's say it was $50,000. Let's say you had a $50,000 capital gain of other investments you had. Okay. So maybe the holding period was a little bit differently. Maybe the investments were a little different, right? But now you have $50,000 as a capital gain. Well, you can use $200,000 and offset that entire $50,000. You can offset up to $200,000 because that's how much in realized losses that you have. But in this case, we're going to completely wipe out that capital gain. And now you're sitting here with $150,000 to offset gains. And oh, by the way, it doesn't have to happen in that calendar year. You can offset gains into the future. There's no limit in terms of how long you can carry those realized losses forward. Okay. But if you have losses that you're carrying forward in future tax years, one of the things that you can do is take up to $3,000 as an ordinary income tax deduction, not even offsetting capital gains, but you can also offset up to $3,000 from your ordinary income deduction. Okay. And by the way, this shows up on line 7 of your tax return. You'll see a realized gain or loss. And if you see minus 3,000, that means you have the max unrealized loss carry forward and you're using $3,000 to reduce your taxable income that year. Great strategy. So now going back to that previous example, we had 150 and now we use $3,000 also in that year to reduce your ordinary income. Now in the future years, you have $147,000 the next calendar year to offset capital gains first and then offset up to $3,000 of ordinary income. Do you understand the power of this thing? Imagine those early years of retirement before you're tapping into your 401k, before you're tapping into your Roth account, before you're tapping into your HSAs, you're most likely going to be relying heavily upon that taxable brokerage account for income. Let's say you're retired at 55 or 60 or 62 years old, before Social Security, before Medicare kicks in. Most likely you're going to be on some sort of state exchange for your health insurance, okay, because you don't have any insurance anymore. And this is a big hindrance for a lot of people retiring early is what are they going to do with health insurance? Look at all those premiums, how expensive things are. Well, if you're keeping your adjusted gross income super, super low, okay, using your losses to offset your gains, using that income tax deduction, you could keep your taxable income so low that your health insurance premium might be basically free. Okay, it's so cheap, it's basically free. Or at worst case, maybe you've got a pension, maybe one of your Social Security benefits has started. You still might receive a pretty substantial premium tax credit to keep that premium low. And again, this is why controlling your taxable income in retirement is so key. It feeds into that. It feeds into your surcharge for Medicare via the IRMA surcharges. It feeds into what bracket you're in for capital gains. It feeds into what brackets you're in for ordinary income taxes. Okay, it impacts everything. Taxes impact everything. Okay, so if you're using this strategy proactively, all of a sudden you can get to retirement and you can have a couple $100,000 of losses you're carrying forward into that first year of retirement. You could make that income virtually tax free that first few years. Okay, if you're smart about it, if you're strategic about it. Now, one thing that I hear, one sort of mental roadblock oftentimes when I first bring this strategy up to clients is, Kevin, I don't want to sell out of investment when it's down in value. That thing is going to recover. I have confidence that, just because VTI is down 20%, it's going to come back in value. Okay, so what do we do in that sense? All right. Well, one of the things that you need to really be careful of is this idea of a wash sale. Okay. So if you sell VTI, you cannot purchase VTI within 30 days, or you could not have purchased VTI within 30 days prior to the sale. So you have this 30-day window, okay, both before and after, that you cannot buy that same investment. You cannot buy that same security. Now, it's very easy with individual stocks and bonds. If you bought Apple and you sold it within 30 days of the sale or within 30 days after the sale, that would constitute, and Apple was the security you were targeting for tax loss harvesting purposes, that will trigger the wash sale. That loss is not going to be allowed. It becomes a little bit more murky with funds, whether it's mutual funds or ETFs, okay? So how do you get around this? Well, you can't replace that investment with something that is substantially identical. So what does that mean? I mean, this is a lot of gray area. There's no specific language in the IRS code to say this is what a substantially identical security is if it's held at the same fund family or if it's a passive versus an actively managed fund. So there's some gray area there. It's, you have to use your own discretion on this one. But I'll give you an example of what probably is substantially identical. If you come in and you sell VTI, which is Vanguard's total index fund, U.S. stock market index fund, and it's an ETF, and you turn around and replace it with VTSAX, which is the same type of investment, but the mutual fund version, I think that would probably be substantially identical, okay? I think you'd have a very tough time proving to an auditor, hey, you know what, I just wanted to swap out this investment for another because I like this one a little bit better. That's going to be tough. They're going to say, no, you were trying to get around the wash sale rule to use those losses to offset capital gains, to offset income. Of course, they know that's what you want to do. But one thing you could do is say, you know what? Instead of Vanguard, I'm going to switch this over and I'm going to go into Schwab or Fidelity. I'm not saying move your funds out of your brokerage account to Schwab or Fidelity, but I'm saying you could purchase ETFs or mutual funds from that fund family. Okay. So, Fidelity's version, what is it? Here's one. FXAIX. Okay, is that substantially identical? I don't think so, actually. I think this is an index fund that's at Fidelity that is more tracking the S&P 500. Now, there you might lose a little bit of exposure into certain investments that VTI has versus FXAIX, but at the end of the day, you sort of get my drift. You could also look at what is Schwab's total stock market index fund, or what is Fidelity's total stock market index fund, and replace it with that. Or you know what, hey, I have this passively managed investment. I'm going to replace that with an actively managed investment. But the key is you have to avoid the wash sale rule in order to use those losses going forward. And that security that you replace, whatever you sold, cannot be substantially identical. And then you start to build that war chest. Each year, you look for opportunities. Anytime the market's volatile, you probably have something in your portfolio that's moving in or out of favor. So take advantage of those situations. Realize those losses. Replace those securities with something that's not substantially identical, and start to build up that war chest that you can use to offset capital gains those early years in retirement. Offset partially, up to $3,000 of ordinary income. This is the strategy, that tax loss harvesting strategy you probably hear so much about, but this is how it actually works. And I hope you all find the video helpful. If you did find it helpful, make sure to like it. Make sure to drop a comment. Are you doing some tax loss harvesting? I know 2024, the market's been mostly positive, but do you have some tax loss harvesting opportunities? Do you have a strategy in place? And of course, make sure to subscribe to the channel. That helps us not only impact you, but also helps us impact more people, which is what we're trying to do. And that's it, everyone. PFR Nation. Until next time, this is Kevin Lau signing off.